Hello, everyone. Thank you for joining the Enterprise Sage podcast today. We have a very interesting guest, Gary Linaway, who's a CPA. That does not stand for cleaning, pressing, and alterations. All right. It stands for really smart people that are really good at taxes and accounting. Businesses all need the tax work, they all need accounting work, and makes a real difference in your business and your profits and your taxes and lots of other things in the professionals that you work with. So at Enterprise Sage, we refer clients over to Gary Linaway as one of several different sources. Gary, it's always interesting how people get into the business. I'm guessing maybe you did or did not start off to get into the business as an accounting professional with CPA and helping all kinds of business owners realize their dreams. So, Gary, what's your story? How'd you get into the business?
I did not come into the business as an accountant. My undergrad was in international business, German, and economics. With that combination, you pretty much have to have a PhD to get a job. So coming out, I had done really good in accounting in undergrad. Uh, One of the professors tried to get me to switch to accounting. I did not. Should have listened to him. But I went back and got my master's in accounting, and it's kind of worked out well since.
Interesting background. How long you had your own firm?
Uh, since October of 21.
21. All right. Growing by leaps and bounds. So, Gary, in the world of tax compliance, people are always worried about making a mistake, and whether it's on their personal stuff or their business stuff. So, just in general, what are common mistakes or misperceptions that people have about being worried about making errors? What do you commonly see as the mistakes?
The biggest mistake is not filling out the organizer. Your tax professional is going to give you an organizer. It's going to ask a bunch of questions that they may not know. You might have bought the solar credit's gone, but if you bought solar, if you don't tell them, they're not going to know. If you have a kid and you don't tell them, they're not going to know that you had a kid. Those are two that people tend to bring up, but there's a lot of little things that we just don't know unless you fill out that questionnaire.
So, kind of garbage in, garbage out. You got to make sure you put the right stuff in. With the questionnaire, are are business owners usually good about filling in all of the information, or they just kind of give you some of the stuff, but there's other information that's commonly forgotten?
Depends. Some of them are really good. Some of them are not. And it, whether it's business owners, whether it's the general population in large, some people are more detail oriented. Some people are more high level and they don't want to get down into those details. Uh, when you're dealing with people, there's no correct answer.
just just encourage them to fill it out, and if you got questions, to ask. Right, so
Right.
you get all the information in there. So, I've always been curious. There are companies that do their own internal accounting, and then the companies that have external people doing accounting external. So, how does the accounting work impact the tax work? And I'm guessing it's in a number of different ways that you see.
Yeah, it's across the board. So some companies that have internal accounting are actually going through audits. They've got professional CPAs doing their books. I worked for a couple bigger firms as well as a private company that was a couple billion in sales. Like the accounting in that is going to be vastly different than the small business. With the bigger ones, the audits going through. It's becoming more about what's going on because there's more complex issues. With the small business, it's literally garbage in, garbage out sometimes.
Mm.
Like uh, when their spouse is doing the bookkeeping or their friend or this or that, you're it's hard to do tax planning when you don't trust the stuff. When you can clearly look at it and say, yeah, this doesn't even pass the smell test. Like I can tell within 10 seconds that this thing's really screwed up. Like it's hard to do tax planning, it's hard to do forecasting, it's hard to come up with a business plan when you have no clue what your numbers are and you have no faith that they're right.
That's interesting. So you take the typical company that's in the 10 to maybe 25, $30 million range. Are they doing is it the spouse or the friend doing the accounting work? Do they kinda have somebody part-time doing it or external? Which do you commonly see in that space, that 10 to 25 million space?
The closer you get to 10, the more likely they don't have a professional. Uh, it all depends. Sometimes businesses try to get a little cheap,
Mhm.
and they're like, "Well, this person is significantly cheaper," but you can tell. When you get closer, the closer you get to 25, those business owners have to be delegating. So the accounting is one of the things that they realize, uh, because you, as a business owner, you can really only do. There's three ways to handle the business. You can only do one, maybe two of them. It's either provide a service or produce a product, sell that product or service, or handle the back end. You can't, if you try to do all three, you're not going to get to 25 million unless you're incredibly lucky, like, because you're just too thin and you're not focusing in one area.
So where you've got a business owner that's focused on the product or the service that they're delivering, and they're trying to do the other stuff, or they're trying to oversee the internal accounting function, but they don't have an accounting background. Um, when that comes to you, is it basically a train wreck that you gotta do all the stuff to put it back together again?
Not even put it back together. A lot of times it's start over.
Okay.
You got to basically take it's so far gone. It's faster to just basically say, "Hey, we're going to take every transaction for the year and just reclassify it because it's too far gone." Sometimes they've updated their thing multiple times. Sometimes they're missing transactions. Just with everything going on, it's oftentimes better just to restart over.
Just build it from the ground up, and then you
Yeah.
know what you got, then you can trust the numbers from there. Um, with CPAs, in my experiences, I've worked with various professionals and working with you and also working with attorneys. Sometimes there's a commonality when I'm asking a tax question or I'm working with a client in a corporate structure and there's a tax question. There's different ways to see it. How do you work with CPAs to help clients find the right structure that's for them?
Uh, you've really got to figure out what are they doing, how are they funding it, and what are they trying to do on the exit. If you don't know those three questions, you're not going to be able to do the correct structure or even come close to it. So there's a few CPAs who put everybody into an S corp, which in some cases is awful. I had a client who was in the manufacturing realm. Uh, they had an advisor tell them, "Hey, you got to be an S corp to save on self employment tax." They weren't paying any self employment tax because they were expanding so much that their equipment write off was basically driving them down to zero.
Hmm.
The owners weren't also allowed to take those losses because uh, they were financing it in a way that didn't give them basis. So they had a bunch of suspended losses that we had to kind of deal with and restructure because they didn't figure out how are you funding it, what are you doing today, what is your income looking like now in the next 5 years, and how are you trying to get out of it? What's your exit plan?
Makes sense. Yeah, just the short sightedness. So that kind of leads me to another question where you're working with the client on their tax structure, right? And unfortunately, some clients just come to their tax professional at tax time. How do you can you talk to me a little bit about how a client can get so much more out of their accounting CPA relationship by doing the tax planning in advance and not just doing that end of year tax meeting, but really it's throughout the year. How can people optimize that? And what do you see with clients?
Well, a lot of it is once that ball drops on New Year's Eve, you've lost 90% of what you can do from a tax plan perspective. There's a few things you can do with retirement plans and stuff like that, but the vast majority of that stuff stops when the ball drops. And even if you get ahead of it early in the year there's some changes and this and that, you can kind of plan for it. There's different things you can do as far as timing of payments and this and that, depending on if you're cash or accrual based. But a lot of it just stops and they wait too late. And they're like, well, what can you do on a tax planning standpoint? I was like, if you have a time machine and we can go back 6 months, there's a lot we can do. But at this point, we've got a tax plan for next year because the year we're filing is pretty much done. And it's a report card of the tax planning from the prior year.
So you've got the accounting part of it, you got the tax part of it. For companies that have CFOs, whether it's a full time or a fractional CFO, how do you work with that CFO resources to help improve the outcomes for the company and the owners?
Well, if they've got a CFO, a lot of the stuff we were talking about earlier, as far as the accounting,
Hmm.
it's probably already been fixed. It's so you can more focus on, hey, what are your projections? Because a CFO is forward looking,
Hmm.
so they know what they're going to expect. So we can kind of guide them and say, hey, if we do this, this, and this will minimize tax because they're actually looking forward instead of looking back,
Okay.
or they should be.
Yeah, they should be. Because I know clients that they have a fractional CFO, and that fractional CFO is just focused on certain things. And then they've got the CPA relationship, and then they've got the accounting internal. But unfortunately, the one I'm thinking of is the accounting person left. And it's like, and it took a couple months to get they had some turnover until they got the right accounting person in there. And the owner was kind of disconnected with, okay, who's doing what here? And it just took some time to figure out. Um,
A lot of times the owners don't know the lanes,
yeah,
especially
well, that,
if they're a salesperson. They don't know, hey, this is more of a CFO, this is more of a payables clerk, outside CPA. They just know that these people are working together. Especially the bigger the business, the further they are removed from those individual tasks.
we worked with some folks that do accounts receivable collection work. For businesses. Somebody has an outstanding debt, um, and they're trying to get the money back from the customers. And it's been 6 months or 9 months. Now they're trying to go out and collect it. Um, how do you help the owners understand how non-payment, from customers, so the customers are late in paying them, how that impacts their cash flows? Or, getting the money in this year versus next year, how that impacts them. Because you're right, if it's a salesperson, they're not seeing it. As you and I both know, a lot of business owners, they're looking at the top line on the revenue side, and kind of everything falls to the bottom in profit, but it's everything that goes into that. So how does the AR process tie into your considerations as well?
It depends. Are they a cash basis, accrual basis? Those are two different answers. From a cash basis, you're really matching revenues to the period. So if it falls in the next period, uh, hopefully you're not in higher tax bracket at that point.
Hmm.
But you're also looking at, hey, if you've got 100 grand in receivables and it's outstanding for a year, what kind of interest are you paying or could you earn on those funds? So it's more of that. On the accrual basis, it's figuring out what's actually are you actually going to get? What do you need to write off? Because it becomes taxable the moment you invoice it, and depending on a few things, but you then have that receivable in your income, even though you don't have the cash. So you got to figure out: do I have to write this off? Will I ever see the money, or is it just a slow payer? So it's kind of two different answers.
Okay, yeah, I can see that. So where your firm is doing the accounting work, do you help clients identify their customers that are slow to pay, or is that all 100% on the firm to track those?
It's usually on from, and this is where those different lanes kind of go.
Hmm.
If it's, and we don't have many of the fractional CFO type or controller work. There's firms that kind of do a good job at that. That falls more to those areas because for us, if they're on the cash basis, we don't really look at their payables or receivables because they don't matter. It's when everything comes in and out. Uh, they should have somebody internally that says, "Hey, this is receivable that is going to be collected. It's going to be 90 days, 180 days." That's kind of on the business owner. On the smaller businesses, on the bigger one, it's with their fractional CFO, and that's part of the value that those guys can do in their lane.
Okay. Yeah, it's sometimes the a sales CEO, a business that's driven by a sales CEO, they're seeing it differently, and they're not aware that it's literally costing them money by having money outstanding, and it's really a revenue opportunity. Um,
And it's costing them money because they are literally going and paying people to try to collect this. So the
mhm.
more they can put into processes to make sure that they're getting paid, the less they're spending to pay people to make sure they get
Costs money to chase money, and the longer
paid.
you
Yeah.
wait, the more it's going to cost. Yeah. Um, there's many different business owners, hundreds of them that I've worked with over the decades, and it's common that as a business grows, they wanna keep their it's like they're emotionally attached to the people that have been doing their accounting work. So as a part-time accountant, okay, now they've gotta upgrade to a full-time internal accountant, and there's just so much resistance to that, and I've always thought because it's the intellectual or the institutional knowledge that that starter accountant had, and then the starter tax professional, and as they upgrade, it seems like there's just barriers to resistance to really upgrading. So, what are the common misunderstandings about when a client's considering changing accounting professional, tax professions? Is it the monster under the bed? Well, you look under there, there's nothing under there, or it is something that's significant. What are the common misperceptions that people have about changing firms or
I think
services?
the biggest one would probably be uh, the cost versus the quality that they're getting. It's one of those things that as they go to a bigger firm or they get professionals doing it, there's a cost to it. But what they don't see is that it's just not correct. So a lot of the times when they're trying to when they're starting out, they're doing it cheaper and they're like, all right, I've got my accounting. I put it into QuickBooks. I know it. But yeah, they don't have a bank rec. Uh, they don't have the initial things that not IRS auditor is going to look for. Uh, First thing they're going to say is, I need a copy of your trial balance, your bank statements, and your bank rec. And if those don't make sense, it's going to be a long audit because they know there's mistakes and it's easy for them to tell right away. So, but a business owner who's involved in sales or a guy who builds machines, he's
Mhm.
not going to be able to look at that really quick and say, hey, it's good. And a lot of times they'll be like, my accounting's worked before, everything seems good. But to somebody who does it all the time, they're like, yeah, your cash shouldn't be negative unless the business has some serious issues. But like, unless you're way overdrawn, your cash shouldn't be negative. I can tell there's an issue.
So they don't know what they don't know until somebody explains it to them.
Right.
How do you so you're working with a new client, right? They've come from someplace else, some other firm, whatever it is. How do you educate them about the services that you provide? You know, it's not just the bullet point, but it's the knowledge and the education that you provide. So how do you walk them through that process?
I think it depends on everybody's situation. It's different.
Hmm.
Uh, if you're going through an intro call, you got to figure out what do they have going on? What are they looking for? And from there, you kind of build up, hey, here's the services that we can do. Uh, and you can almost try to figure out where their weaknesses are.
Hmm. That's an interesting one. You go into that a little more further, a little further. Where the weaknesses are? Is that the gaps in the knowledge, or the weaknesses in their processes, or a combination of the two?
Uh, both. So are do they not realize what like what they don't have? Uh, if I'm looking at a industry, so I did a lot of breweries and stuff like that in my earlier days. The first thing I could do is look and see, are they even taking the tip credit? Something that jumps out right away and say, hey, we've got issues here because like some of the basic stuffs. And like that's the type of thing where you can kind of get a good idea on some of the errors. And then it's also from a mindset. Do they really know that they're running a business or is the business running them? Uh, it every call ends up into a different direction.
Okay. Do you frequently find that business owners in that 10 to 25 million space, they see their tax professional just as the compliance resource, or a lot more than just the compliance resource?
Both.
Okay.
Uh, and a lot of it depends because it's a wide range, especially depending on the type of industry. So
Hmm.
if you're a equipment heavy company in that space, you're probably going to use your CPA for some sort of review or uh, compilation or something that the bank's going to require. So you're going to have to do a little bit more there. There's the tax planning side on ones that don't have debt. Uh, there's also a little bit, and you see it more on the lower end, where you're the one person they know that knows on the financial side. The ones who don't have a CFO, they'll tend to call more because you're the closest they've got to somebody who understands the financial side to bounce ideas off.
So for the owners, in a way, where they walk in the door just focused on tax compliance, they could be unintentionally disadvantaging themselves.
Yes. And it also makes tax compliance harder. If you've got a working knowledge of stuff because you did a projection in November, you know where the income's going to come in.
Mhm.
You're not rushing in March to try to figure things out. Uh, you've got a relationship. So when you call, you're talking to your CPA 3, 4 times a year. Uh, there's an more of an understanding of what's your business model, how are you growing, and what are you trying to do. So they know more of they know your business is the best way to put it.
So if you see put it this way, where owners are just working with their tax professional on compliance, they're leaving so much more value on the table.
Yeah, and in most of the cases, they don't even realize it. Trying
Yeah.
to save on a tax plan or a projection, couple thousand dollars.
Hmm.
Oftentimes, it can even lead to more. And the bigger the business, the more important it is because there's so much more room to figure out what's going on. And a small mistake compounds a ton.
So how do you work with a client's other professionals? So, their banker, just some examples. So people that maybe are not utilizing their CPAs as much as they could. So the bankers, the attorneys, the other professionals, how do you typically work with them?
It's across the board. A lot of it's client need. So attorneys, most of the time, the attorneys are brought in because they're doing something. And for us, it's what's the effect of that? Are they buying a business? Are they selling a business? Are they trying to transition to the next generation? All of those things have tax effects, uh, and it's figuring out how bad it's going to be, and is the outcome going to be, would the outcome change due to the tax effects of that plan? And a lot of times the bankers, it's just because they look at the books and they're a disaster. If they're going to try to lend on something and they can tell that, again, negative AR, negative cash, like if they looking at things and they're like, I had two accounting classes and I can tell this thing's wrong. A lot of times that's when we get referred in to try to clean some of that up.
Just thinking about that, if the banker sees the books are in a mess, is that the tip of the iceberg and the rest of the business is a mess? Versus you got somebody who
Yeah.
has clean books, they're more bankable just because they're demonstrating organizational leadership.
Yeah. It's a little bit of the organizational, but also that they can then have more faith in it. This company is going to cash flow and be able to pay their debt.
How so let's you got there's the old saying, you always go get money when you don't need it, but when you do need it, good luck getting it. Um, so where a client comes to you, their books are less than bankable, right? They know they need to get stuff cleaned up, or they've already been turned down. How long does that cleanup, that rebuild typically take before they go back to a potential banking resource for capital?
All over the board. It depends on how bad it is, how many transactions are included. Uh, it's just hard to predict. Also, if the books are bad and you clean them up and if the books are bad from a fact that they're totally not incorrect,
Hmm.
you clean them up, they're correct, and it's showing that they're profitable. It becomes a lot faster if you clean up the books and not only were they a mess, but it it doesn't show that they're going to be close to making payments. It's going to be harder because you're going to have to prove it a little bit more because they're not going to give you money if one, you're a mess, and two, you're not making money.
Let's go through a scenario here just for a moment. You've got client A. They're a new client. The older generation wants to sell it to the younger generation. Um, you know, Mom and dad had the business. Now the son and daughter are going to come in. They're going to buy into the business. Um, Parents are going to they're going to cover part of the carryback note, sell their carryback note, and they have to go get financing for the rest of it. Um, Business has been up or operating 10, 15, 20 years. All right, it's a stable business. At the same time, mom and dad have been taking all kinds of money out of this. So it doesn't look as profitable as it actually is. And the bank says the accounting's not in order, cash flow, the coverage ratio, just some things don't quite work here. You ever see that or that part of a scenario or different pieces of it?
Yeah, and it's actually similar to a sale, like uh, a third party sale when they're trying to look at what will this do for me. There's a bunch of ad backs here, so if you can take a look at the ad backs and figure out what's the true value, it makes it a lot easier. Uh, there's certain things that small at a smaller scale, the owner's cell phone is
Okay.
not
Yeah.
going to need to be kept up. There's some significantly bigger ad backs too, depending on what it is, but you just kind of have to figure out what's the what is it really earning. And if it's distributions and cash look bad, all of that's going to get accounted for because they're taking out a ton of cash. It means that there's a ton of cash to help pay the debt if the new owner doesn't strip the company the same way.
So how often do you or does a situation come up where you've got the CEO, and they're really focused on the product production, right? Product manufacturing. So they're making something, whether it's food or metal or whatever it is. And they don't have that accounting, finance, tax expertise. Um, and they're going to sell it to the next generation, or they're just going to sell it, right? Um, and they need somebody with your critical eye, with your mindset to really position this for the sale. How early should they start doing that?
3 to
And
5 years.
3 to 5 years. Okay.
Yeah, and the thing is sometimes you can get away with it a little less, but you really need to start getting things in place
Mhm.
because if there's a bunch of cleanup and they can tell there's a bunch of cleanup, they're going to start questioning things. Uh, if they can tell, hey, this thing's been done for a while, there's also some tax planning stuff that if you're getting ready to sell, you wouldn't do.
Mhm.
So might make sense. And that's what we were talking about earlier. Like, hey, what's the right tax structure? You got to figure out what the exit plan is because if they're trying to get out, there's certain accelerated deductions that just don't make sense. Uh, if they're going to be out in a year, why pay for something to defer money for a year when it's just not going to really save them because you're paying a bunch of fees to do something that'll accelerate, whether it's uh, one of those captive insurance or even a cost seg where you're spending 5 to 10 grand to defer tax a year. Why not just save the money? And because you're going to pay it either this year or next year, you're not saving it for 20 years or it pays for itself.
So where you've got that cleanup that's gotta take place, right? X number of
Yep.
years. If they don't do it, it's gonna cost them money at the exit. Is that a reasonable assumption? They're gonna be able to sell it for less?
Yeah.
Or yeah,
Buyer's not going to take the risk.
yeah.
If there's questions, the price drops. Uh, Also, a lot of times what happens is we've picked up some clients from brokers who basically said, yeah, you're not sellable at this point. You got to go get your stuff cleaned up. Call me in a couple of years. And that all screws up your timing.
So they could sell it, maybe. So it's gonna
Yeah.
take long if the stuff's not cleaned up, it's gonna take longer to sell it, and you're gonna end up selling it for less. So why not do what you need to do, if I'm hearing this right, do what you need to do, get get with someone who has the forward-looking, abilities, the experience, clean up the accounting work so it's bankable for the next buyer, um, still deploy, advanced tax strategies, not at the end of the year, but a couple years ahead of time. Um, you go a little bit more into how CPAs can help with the forward-looking tax planning and the management. So what are you looking at 2 to 3 years out commonly with your clients?
Again, it's exit strategy is everything. If you're going to be around for multiple years, you may want to do some tax planning that pushes expenses forward. Uh, and then you're deferring it. So each year you're kind of kicking the can down the road.
Mhm.
But if you take that savings and you offset it against some of your interest, you're going to be further ahead. Uh, that's the biggest thing is when you're forward looking, it's what do you think is going to happen? The other thing is if you're putting a new product in place, you know you're going to have a high tax year,
Mhm.
especially with the pass-throughs, partnerships, and S corps. You've got tax brackets. Uh, you don't want to push a ton into the 37% bracket because it's the highest. If you can spread some of that out, you're in the 24. You've just basically saved yourself a decent chunk over multiple years and cut your tax over those years significantly.
Hmm. What percentage of clients are already at that level before they walk in your door? Before they
Uh,
become a client? Is that the norm where they're at or the exception?
it's 37 is the exception, but a lot of them are in the 32, 35% tax brackets.
Mhm.
Or if they're starting to build,
Mhm.
uh, they're going to get there fast.
Okay. Makes sense. As we're wrapping this up here, what are some common fears that you hear from new clients? Just things that they're afraid of, and a lot of times that's simply the unknown. You know,
That's the number one thing is the unknown.
yeah,
So
yeah.
I don't know what I don't know. If I'm going to go somewhere else, am I going to owe a lot of tax? Am I going to save a lot of tax? What's the bill going to look like? Well, is there going to be more work for me? Is there gonna be less work? Like it's that's the biggest thing is people are one afraid of the IRS, so
Yeah.
they're hesitant there. Hey, if you're going to do something, is it going to be a red flag and I'm going to get audited right away? If I make it, I've had somebody ask if I make a change with CPAs, does that up my audit risk? Uh, it's just you don't know what you don't know.
Okay. That is going to up my audit risk. Okay. Huh. That's an interesting one. Um, so Gary, I would like to wrap it up with this. What's advice that you've received in your life that impacted you and or advice that you'd like to share with others, whether it's life advice, no tax advice, or professional advice? What's advice that's been impactful to you, or that you'd like to share with others and potentially impact them?
I think the biggest thing is from a business standpoint, there's kind of a triangle. And the more you go in one direction, you have to give up on the other. So it's basically your price, your quality, and your responsiveness. You can't keep a low price while being responsive and then provide quality because you could do two of those, but the quality is going to be out because you have to go through things so fast that you're not double checking it. So it's finding that medium that works for your industry, and everybody's industry is different. Uh, Ruth Chris and McDonald's both sell beef, but they are different angles of that matrix. Well, actually, McDonald's getting expensive, but they're they're different angles of that triangle, and you got to figure out which one fits for you.
Yeah, we had steak the other night, and it was $50 for the steak, or it was $8 for the hamburgers. You know what? We'll go with steak. I don't. Yeah,
Right.
you're from that other one. Yeah, that's interesting advice. Anything else that you'd like to wrap it up with today?
I think the biggest thing is a lot of clients that I'm seeing, their biggest complaints that they're not communicating with their CPA. They're like, they don't communicate with me, this, that. Uh, it's a two-way street.
Huh?
If if you're not reaching out or you're not asking questions, and if you don't fill out their organizer, you're kind of getting what you get. Like, and that's a little bit of like the issue is hey, it's a two-way street. They're not if you seem too busy to fill out your organizer, you're
Uh-huh.
probably too busy for your CPA to call you because you're not going to want to take the call. Like, if you seem uninterested, they're not going to bug you. Like,
In your professional opinion, by what everything I'm picking up and just personal experiences and working with you, it seems like the clients that intentionally put it on their calendar to meet with their CPA, 3, 4 times a year, an hour, hour and a
yeah,
half, it's money well spent.
yeah. It's honestly the advising and that is actually more valuable for the client than the tax prep. I came from firms at hourly bill, and when you do the tax prep, you you would bill by the hour, but your value filling out the forms wasn't as good as what you could do when you did the actual tax plan. And whether it's
So
a tax plan or just business advice.
it's the intellectual capital. So you have the professional relationship, accounting, tax, compliance. It you got to tap into the intellectual capital of the professional to really realize the value. And it seems
Yeah.
like that the potential tax savings more than outweigh the cost of that advice. Just the time. Just yeah.
Or even the potential, uh, basically not making a mistake. I've got doctors who I got one who bought a machine for a tax deduction, a 100 grand machine at 18% interest. It hasn't paid for itself. So he just spent 100 grand to save $30,000. Like you don't spend dollars to save quarters. So a lot of times you want to pay more tax. It means you're doing better in business, and it means you're not wasting it on things that don't make you pay more in tax. You buy a piece of machinery, you want that piece of machinery to make you pay more in tax because that thing is you bought $100,000 piece of machinery, made you 500,000. It's made you $1 million. You're going to pay more in tax, but you did it for business reasons. If you're doing stuff for tax reasons with your business, it's usually wrong.
That's the tail wagging the dog.
Yeah.
Yeah. Got it. Have a client situations where they were looking at large expenditures, like, you know what? Why don't you lease a unit for a year or two, see how it's going to work out, and give the option to convert that into ownership later. And it could potentially put you in a better negotiating point rather than the large capital outlay, and you don't know what the outcome's going to be. So,
Right.
yeah, take it out for a test drive for a year or two and see what the revenue is going to generate. Makes sense. Gary, how should people get a hold of you?
Uh, they can get a hold of us. One, the easiest way is just give us a call, 480 6682.
Okay.
The other way is our website, which is L and B CPAs spelled out. So it looks like landbcpas.com. You can't use the and sign, so we have to spell it all out.
Okay. Got it. Got it. Gary, I've been asking you questions. Any questions for me today?
How are these things going? You enjoying them? Uh, is
Podcasts?
it
I love them. They are it's an opportunity to bring information to the audience. We get a number of follow up, just emails, inquiries, phone calls from them. Just the number of things that we are helping people with, just see things different that they didn't think about. Our target market is business owners, and and, and just helping them with their knowledge so they're armed with better questions when they come in to see you. So they have not unknown expectations, but they have higher expectations just by the information they get from the podcast. And,
Yeah, and then speaking of that, how did you go the whole podcast without your dog up there barking or interrupting? Because mine would have never done that.
well, that's our talking husky. She's pretty smart. She knows over 100 words. So she's just really, really good. And, yeah, that's Kira, the talking husky. So she likes to talk to everybody. Yeah. Anyway, Gary, it's been a pleasure having you on today. Really appreciate your time.
Well,
As
thank you.
always, everyone on listeners, continue to hit the like buttons on our podcast. If you have questions, please reach out. If you'd like to connect with Gary, you want to talk to us, you know how to get a hold of us. Gary, thank you again very much for your time today. We certainly appreciate it. Have a wonderful day, everybody.
Thanks.